What is debt-equity ratio? Debt-equity ratio shows the relative proportion of shareholders' equity and debt a company uses to finance its assets. Put simply, it tells us how much debt people use to run a company. It is one of several financial ratios we use to gauge a business's financial leverage and overall health. The terms debt-to-equity ratio and DE ratio mean the same thing. Equity in this context refers to the value of the shares that a company has issued. If a company has issued 10,000 shares at $1,000 each, its equity value is $10 million. Debt is money that a company borrowed and must pay back. If it owes a total of $1 million, then its total debt is $1 million. Debt-equity ratio is the most common financial leverage ratio. It is a measure of the relationship between capital that comes from creditors and capital originating from shareholders. It can also tell us the extent to which shareholders' equity can meet creditors' obligations. In the event of a liquidation, it is important to know what financial obligations stockholders' equity can meet. Let's imagine a company, John Doe Inc., has debt totaling $20 million and stockholders' equity worth $15 million. John Doe's debt-equity ratio is calculated by dividing 20 million by 15 million, which is equal to 1.3 or 133%. This means that for every dollar of John Doe belonging to its stockholders, it owes $1.33 to creditors. Thank you for watching this brief video on debt-equity ratio.